Billy, are you answering that you can hear me? When I say it, say the number, someone type in the number 25 if you can hear me. Just type in 25. Yes, yes, yes. Okay. All right. I promise you all alcohol was not involved. We just had a little technical problem. Thank you very much. Okay. All right. So welcome. Well, nothing like being 30 minutes late. Okay. How's everybody doing this morning? Well, it's this morning where I am, so hopefully it might be afternoon where some of you are. My heartfelt apologies. We had some technical issues. I'm old enough that computers and I are not on a first name basis, but thanks to Shar and Nick and Ross, got some great guys behind me trying to help me. Helping me with computers is no easy task. Anyway, welcome to the Pinnacle Institute. Our session today, we're going to talk about selling option premium by profiting where a stock doesn't go. So, my name is Steve Moses. I'm coming to you live from Napa Valley in California. I see some familiar names in the chat box, so that's very nice. Welcome aboard. It's Friday, June 25th. All right, so we're going to talk about selling option premium. And you know, there's only two things you can do with options. You can buy them or sell them. That's it. You can't take your option out to dinner. Okay, there's only two things you can do with an option: buy them or sell them. If you buy an option, that's a directional trade. If you're buying a call or buying, there's only two options: calls and puts. If you're buying a call, you're buying the right to buy a stock at that price, no matter how high it goes. If you're buying a put, you're buying the right to sell a stock or short a stock, no matter how low it goes. Okay, that's pretty easy. That's leverage as opposed to buying or shorting stock. But when you sell options, you don't have the right to do anything. You're taking on an obligation. And the obligation you're taking on is to either buy or sell stock. Okay? When you buy options, those are directional trades. You need the asset to move in a certain direction. Trading stock what's a directional trade? Trading stock is a directional trade. You buy stock, goes up, you make money, goes down, you lose money. You short stock, goes down, you make money, goes up, you lose money. Most trading that anybody has ever done has been directional trades. Any investment you make is a directional investment. You buy something, it has to go up to sell for more than you paid for it. You sell something short, it has to go down to buy it back for less than you sold it for. Okay. We're going to talk about selling option premium now. Now, if you've never traded options, then that means that every trade or investment, if you've traded stock, futures, forex, everything that you've ever traded, real estate, anything you've ever invested in, you had to be right on the value of that thing changing. And if you were right, you made money. If you were wrong, you lost money. But with options, when you sell options, you not only don't have to be right on where it's going, it doesn't have to go anywhere. And it can even go in the wrong direction somewhat and still make a profit. And that's what we're going to talk about this afternoon. Selling option premium and profiting by where a stock doesn't go. Now, welcome to the Pinnacle method of trading and investing. We have some upcoming workshops. We have two basic kinds of workshops, introductory and advanced. Obviously, the introductory workshop would be for those who are very new into trading and investing. And that could be so new that you have no experience, or you're at least unfamiliar with supply and demand as a trading strategy. And we've got 3 upcoming webinars starting tomorrow, all throughout next week, Saturday, Tuesday, and Thursday. And this is a great introduction to trading supply and demand. And for those of you who have used supply and demand in the past, or you have extensively studied trading experience or supply and demand, we have some more advanced workshops coming up also this week, tomorrow, Wednesday, and Thursday. So whatever is appropriate for you, please feel free to join us in those workshops. I promise it will be a very eye-opening experience based on your experience. All right. So why are we in the stock market? Pretty simple. Make a profit. That's it. That's the only reason we're in the market, to make a profit. Okay. I know that sometimes people will say, well, I'm buying stock. I want to support a company and I want to support the economy and blah, 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 blah. Okay, fine. But the reality is, personally, The only reason we are in the stock market, the only reason we get into any type of investment is to make a profit. That's it. That's the only reason. Now, as I mentioned, I think options are the greatest thing ever invented. Okay? Well, all right, single malt scotch is up there, but options financially, I think options are the greatest thing ever invented. Okay? And we're trading for a profit. And if we all agree that the only reason we're trading is for a profit, why are options the greatest thing ever invented? Because as it says, what if you could profit and be a little wrong directionally? And I've been teaching options and training people on options and trading options myself for 17 years. May of 2004, I got involved in options trading. And like many of you, by the way, I'm not a financial guy. Many of you have maybe gotten educated by people who are hedge fund managers, floor traders, stockbrokers. Like many of you, I was just a regular guy, had no experience. Matter of fact, I was in the publishing business, advertising, sales, and magazine publishing for 20 plus years. PC Magazine, Computer Shopper, United's In-Flight Magazine, and I got dragged to a class in May of 2004 and had the whole trading and investing world open to me for the first time. And I did not know anything about options. I probably couldn't have spelled options back in 2004. But when I was at that introductory workshop, the thing that blew my mind about options was what it says on the bottom. What if you could profit even being a little wrong directionally? And I being a New Yorker, when someone said you could be wrong directionally and make a profit, I'm thinking they're trying to scam me. I mean, if you buy a stock and it goes down, you can't make money. If you short a stock and it goes up, you can't make money. How can you profit by being wrong directionally? It seemed so un-American. It seemed to go against everything that I'd ever heard of. Well, options are the reason you can do that, because options have something that no other asset class has. And that's an expiration date. Well, let me just back up for a second. Futures contracts have an expiration date. Okay, I'll give you that. Stocks don't, forex don't. Futures contracts have an expiration date. But what makes options even a little different is not just that options have an expiration date, but that you're going to buy or sell the option for more than it's worth intrinsically. So let's say an option expires next Friday and a futures contract expires next Friday. If you're trading oil futures and the oil futures contract expires next Friday, if oil is trading at $72 a barrel, doesn't matter that the contract is expiring, you're still going to go long or short the oil futures contract at $72 a barrel if that's the current price. But with options, if the options expire next Friday, July 2nd, and the stock is trading at 100 and you have a $100 call option, it's going to be worth something intrinsically, but you're also going to pay for the 7 days until the option expires above what it's worth. So again, one more time, if you're trading an oil futures contract and oil's at $72 a barrel, that's it. Doesn't matter if that oil futures contract expires tomorrow, next week, next month, or 9 months from now. You're only going to pay $72 for the oil futures contract. But with options, because that's what the oil futures contract is worth intrinsically. It's worth $72 intrinsically because oil is trading at $72. You're not going to pay more than it's worth intrinsically. When you trade stock, if a stock is trading at $48.50, you're not going to pay $49 if you can buy it at $48.50. Okay. But with options, options not only have an expiration date, but the time between now and the expiration date, you're going to pay for that time, or you're going to sell that time above what the option is worth. That's called extrinsic value, and we're going to trade extrinsic value. We're going to be able to buy or sell options for more than they're worth intrinsically. Does that make sense, everybody? And if you're new to options, this is usually one of the things that everybody has to get used to with options, because nothing in your financial trading or investing life has ever had extrinsic value. So because of that, we're not just trading directionally. in a sense, what we're trading is time. You're actually trading time. So when I say, could you profit and not have to worry about being right directionally? What if you could profit even being wrong directionally? Or what if you could profit and the stock doesn't even have to move? You don't need the stock to move, but you need the calendar to move. Because if you're trading time and time goes away, then the time that you sell will expire and become worthless. I'll explain that. Okay? Now, so let's take a look at this here. This happens to be a chart of Amazon, and it's from this week. Okay? So as you can see on the screen here, the candle all the way to the right. Now, I highlighted that box over there. Okay? If you shorted Amazon, now that was a couple of months ago, the highlight that I have there is when Amazon was at around 35.54. That was the day after Amazon's last earnings in April, a couple of months ago. And as you can see, that Amazon is at a supply area from last year. Now, if you're trading stock and a stock is at supply and you want to make a profit, you could short the stock. So if you shorted Amazon stock at 35.50, how do you make money? The stock would have to fall to make a profit. In other words, you need the stock to move in the correct expected direction to realize a profit. If Amazon drops, you profit, and if the stock rises, you lose money. That's the directional trading we're used to. Get the direction right, you win. Get the direction right, you lose. Now, had you shorted Amazon stock back in April, you'd have made a lot of money. Now, just to be fair, not many of us are going to short a $3,500 stock. Okay, if you were going, I mean, your margin requirements are out the wazoo. You can't short stock in an IRA. Okay, so there's some problems with shorting stock. Okay, margin requirements, options approval levels, and is the stock even shortable? Can you borrow the shares to even short it? But assuming you qualify for all of those, had you shorted Amazon stock back here in April, you would have had a very successful trade. But in hindsight, you would have only had a successful trade because the stock did drop. Does that make sense, everybody? Okay, now what we're going to talk about is how you can profit with a stock at supply. Okay, if you were going to short 100 shares of Amazon, that's $355,000 worth of stock you're shorting. Your margin requirement, even if it's 25% of $355,000, that's like 90 grand of margin. If you're following any prudent money management rules, you need practically $1 million account, $900,000 account to do that. All right, now, the candle over here to the right, the furthest right candle you see, is from Monday or Tuesday this week. So Amazon dropped from April and came all the way back up almost to our proximal line. And this is current. Well, not today, but this was 3 days ago. This is current. This supply zone, this is current. Okay? Now, we're coming back up to a supply area. All right? So let's take a look. Now, back in April, the stock did move. But what if all we needed to happen to realize a profit on a bearish trade was not for Amazon to drop, but to just not go up? So I drew a line at 35.80. Okay, and I'll explain why in just a second. The distal line of this supply area is 35.54. Okay, now you could profit, and all the stock needed to do is stay under 35.55 or 35.60. I chose 35.80, and I'll explain why in a few minutes, because it's 25 points above the distal line. But what if I entered a trade? What if we entered a trade, a bearish trade on Amazon, and the only thing that we needed to happen to profit was not that the stock went down, it just didn't go over 35.80 by the time the option expires. Does that make sense? Now, let me ask you a question. Obviously, any trade can go against us for any reason. But which do you think is a greater probability of happening? That the stock hits supply and goes down, or the stock just doesn't go to a place that it's never been before? Because, by the way, 35.54 is not just a supply area. That is the all-time high on Amazon. Now, I want to be clear. I'm not saying Amazon is never going to go above 35.54. I'm not saying Amazon is never going to go above 35.80. Obviously, if I knew what Amazon stock was going to do in the future, I wouldn't be here talking to you, right? I mean, if anybody knew what a stock was going to do with 100% assurance, I would take out a home equity line, back up the truck, and move to Scotland, okay? So what we're dealing with when we trade options is probabilities. The whole concept of identifying supply and demand zone is the probability of finding institutional orders, finding where the big guys have their orders, okay? So we could get into a bearish trade. We could short the stock, and we need the stock to go down. We could buy put options. We could buy a 35.55 put option. That gives us the right to sell the stock at 35.55 no matter how low it goes. And by the way, back in April, the last time the stock was at 35.54, if you had bought a 35.55 put option, 2 weeks later, the stock was down at 31.50. Well, the stock may have been trading here at 31.50, but you could still sell it at 35.55. That's a beautiful thing. And the cost to buy the put option, while it would not be an inexpensive put, would be a lot less margin than shorting the stock. And you could buy put options in an IRA. Okay. Now, what if we rent? So think about it. Now, I'm going to show you some orders. I placed this trade this week. I am out of the trade already, just for compliance purposes. I'm going to show you my screenshots from my brokerage statement. I entered a trade on Tuesday this week, okay? And I needed Amazon to stay under 35.80 by today. And we're going to look at that, and then we'll go to Think or Swim in a minute, and I'll show you the chart, because Amazon is actually down again today. The stock has actually moved very well, and the trade worked out very well. But the trade that we entered was that Amazon needed to stay under 35.80 by today. Now, when I took this screenshot, the stock was at 35.05. So first of all, as it says here, what if all we needed to happen to realize a profit on a bearish trade was not for Amazon to go down, but to just not go up, to just stay under 35.80? In other words, to stay under a level it's already under. What if we rendered direction irrelevant? Now, let me ask you a question. I took this screenshot. The stock, as you can see, was at 35.05. This is a real screenshot from the other day. What has to happen for a 35.05 stock to stay under 35.80? The answer, nothing. Nothing has to happen for it to stay under 35.80. It's already under 35.80. So it's not as if the stock has to go down to get under 35.80. It's already there. So in other words, we could have entered the trade on Tuesday, sold some options, collected a premium. Those options would expire this afternoon at 4 o'clock Eastern time when the market closes, because these options had an expiration date of June 25th, which is today. And I will show you the confirmation slip. I took screenshots of it earlier. So think about it. On Tuesday, we could have entered a trade on Amazon that is technically considered a bearish spread trade. However, the stock didn't need to go down. It just needed to not go up. It just needed to stay under 35.80. Does that make sense? Okay? And if you think about it, the stock's at 35.05. Well, wait a second. We just needed to stay under 35.80, which means the stock, so think about this. The stock was at 35.05. If the stock went down, is it still under 35.80? Yes. If the stock traded sideways, Is it under 35.80? Yes. If the stock went up 74 points, is it still under 35.80? The answer is yes. How many of you have ever entered a trade, excuse me, or an investment where the asset could go in all three directions and you could still make a profit? That's why options floated my boat 17 years ago. That's why I decided to learn about options, because I sat there in that hotel ballroom, and when I was shown something like this, where I could enter a quote unquote bearish trade, the stock could go up. I could be wrong, just not really wrong, okay? And make a profit. Blew my mind. Now, I just want to be clear. We're looking at this chart, and anybody has any questions, just put them in the chat box, okay? We can enter a trade, and we don't. So this was on Tuesday, June 22nd, 3 days ago. We didn't need the stock to move. What we needed to move was the calendar. We needed 3 days to go by. We needed to get to June 25th at 4 o'clock Eastern, 1 o'clock Pacific. And we just needed the stock to be at or below 35.80 by the close of market today. Okay? Does that make sense, everybody? So we rendered direction irrelevant, and actually we even put ourselves in a position where this stock could have gone up 74 points and still been under 35.80. All right. Now, as you can see, again, Amazon is trading at 3,500, 3,505, or 3,500, and this took different screenshots. If we enter a bearish trade with the stock at 3,500 and all we need to profit is the stock stays under 35.80, boom. Amazon can go down, sideways, or even up and still be under 35.80. Now, why did I choose 35.80? Well, first of all, okay, if you think about supply and demand, what is a supply zone? Okay, now we're not talking an all-time high. We're talking a supply zone. The probability of a supply zone is where a supply zone represents the probability of there being unfilled, probably institutional sell orders. See, if you and I want to sell 50 shares or 100 shares, and we put an order up here at 3,500 to sell stock, we're going to sell our 50 or 100 shares in a nanosecond, okay? We'll fill it real quick. But at the end of the day, if you're trying to sell 1 million shares at whatever price, how long is that going to take? Okay, that's going to take a lot more than, you're not going to sell 1 million shares in one order, okay? You'd never get filled. You also wouldn't have an order to sell 1 million shares, okay? But if we have a distal line of 35.54, that just means that if the supply zone holds, we are not expecting this stock to go above 35.54. That's the nature of supply. If in fact there are institutional sell orders up here in large enough volume, I mean, look at this. In the last 2 weeks, this stock has gone from 3,200 to 3,500, just like it did back here in March and April. And why did it stop at 35.54? Because that was a supply area from even further back. Now, look, obviously, every supply area where there are unfilled institutional sell orders and every demand area where there are unfilled institutional buy orders, those zones don't hold forever. I mean, come on, guys. I've seen stocks channeling between supply and demand for like a year. I mean, I have some charts on my Thinkorswim, like BIB last year stayed between 15 and 45 for like 8 months. A few years back, IBM was trading in a 25-point range for 10 or 11 months. Netflix was hitting its head last year on a supply area for a year and a half. Eventually, zones get broken. Eventually, either market conditions change, news changes, institutions just change what they're doing. That's all well and good. And zones don't hold forever. I mean, frankly, if zones held forever, the market, there wouldn't be any volatility. There wouldn't be any market if zones held forever. Okay, but 35.80. I took a price point that we need the stock to stay below, and that price point that I needed to stay below is above the distal line of the supply zone, which means, let me ask you a question. If the stock, and just listen to my question, if the stock doesn't go above 35.54, can it get to 35.80? Of course not. I didn't say, can it get above 35.54? I said, if it doesn't go above 35.54, can it get to 35.80? The answer is, of course not. Now, look, obviously, Amazon could gap up. Amazon has had days where the stock has moved 200 points. And I'm not even talking about the day after earnings. Amazon is one of those gappy stocks. It's one of those stocks where it could easily move. Heck, Amazon is down 50 points right now today. Okay. Amazon was down 70 points yesterday, 68 points yesterday. So Amazon is one of those stocks that could easily move 50, 100, 150 points in a day just because it's a pretty expensive stock and it moves. And I'm not even talking about, a couple of years ago when Trump tweeted that Amazon wasn't paying enough in taxes or wasn't paying enough in shipping and the stock tanked. But it's one of those stocks that can move a lot. Okay. Now, the number that I chose, 35.80, that was kind of personal. I could have chose 35.70. I could have chosen an option at 35.60. I could have gone up to 35.90. And I'll explain that in a second. But basically what I did was I chose a price point beyond where I thought the stock was going to go. Now, the further beyond 35.55 you go, the safer the trade. Well, the safer the trade, the less risk. The less risk, the less reward. Okay? But I like to give myself a little wiggle room between the distal line of the supply zone and what I'm selling. Okay? Now, does that make sense, everybody? So I entered a trade on Tuesday of this week. I sold a 35.80 call option. Now, that's a naked call if you just do that by yourself. There's nothing wrong with a naked call. It just has unlimited risk to the upside, just like shorting stock. If any of you have ever sold stock short, in every class I've ever taught, when I ask who's ever sold stock short, some hands go up. Well, obviously, that theoretically has unlimited risk when you sell stock short. Okay, and some people are okay with that. Now, obviously, while it technically on paper has unlimited risk, stocks don't go to infinity, okay? Even if a stock gapped 200 points above your supply zone, it's not gapping to infinity, okay? It's not, the Buzz Lightyear school of trading to infinity and beyond, okay? From Toy Story. But your broker, but because there is no zero to the upside, if you are going to short stock or sell naked calls, the margin requirements are going to be pretty intense because you just don't know, your loss is not capped, okay? So I'm not going to just sell a 35.80 naked call, okay? Yes, I'd have collected more premium. Absolutely, Jose. It's not GameStop, or AMC. Well, GameStop really went up like 400 points in 4 days, and that was just kind of nuts. And forget GameStop. What about Tesla? Early last year in 2020, before the COVID stuff happened, before Tesla split, the stock went up 400 points in 5 days or something, if you remember, before the stock split 5-1. Tesla just was, there was 1 week where Tesla literally went from like 400 or 500 to almost 1,000 in a week. GameStop was kind of nuts because the stock didn't justify going to 500 fundamentally. Tesla at least was, there are some people who think GameStop is going out of business unless they reinvent themselves because of what their business model is. I'm not going to have that conversation, but anyway. Well, crypto, though, is a little different because crypto is, we're not going to have that conversation now. Crypto is at least an opinion anyway, but GameStop is a business. And GameStop's P&L and their business and their return on equity didn't justify $500 a share from $20 a share in a month or in 2 months. Crypto, I mean, kind of justifies it. If enough people think something's worth something, then maybe it is. But at least with GameStop, the business model said it wasn't worth it. Okay, good. So we're not expecting Amazon to go above 35.54, let alone get to 35.80. Now, remember what I said. I'm not saying I'm betting that Amazon will never get to 35.80. But on Tuesday of this week, I was speculating that Amazon wouldn't get to 35.80 by today. This was a 3-day or 3.5 day, because I got in early Tuesday, a 3.5 day trade. Okay, now, how do we profit where a stock doesn't go? We're going to trade out of the money options. We're not going to buy and sell options that have any value. We're going to trade out of the money options that have no intrinsic value. So here is part of the option chain. And as you can see, there's today's expiration date. I took this screenshot a few days ago. There's June 25th, 2021. That's today. June 25th is now today. So I took the screenshot 2 days ago on Wednesday. Okay. And you see the column that says intrinsic. Okay. And you see extrinsic. Okay. Here is the strike. All the way on the right is the strike prices. Okay. Everybody can see that. So up until you get to 34.70, the strike prices were $5 increments. Once you get beyond 34.70, there are $10 increments on the strike prices. Okay. Now, I said that what I was going to do was look to sell a 35.80 call option. So here you go, 35.80. I'm going to look to sell a 35.80 call option. Okay. Now, if I sell a 35.80 call option, that obligates me. When you sell an option, you take on an obligation. If I'm going to sell a 35.80 call option, I am now obligated to sell shares of Amazon at 35.80. However, if I sold a 35.80 call option, that means somebody else did what? Means they bought a 35.80 call option, which means somebody else bought the right to buy. If you bought a 35.80 call option, you bought the right to buy Amazon at 35.80. I have to sell it to you at 35.80 if you exercise your option. But guys, if Amazon is under 35.80, who is going to exercise their option to buy Amazon from me at 35.80 if they can buy it on the open market at 35.50? Red Sox fans. No. Well, I understand why they would do that, Jose, because they think it's going to the moon. But in reality, even if they think it's going to the moon, if somebody bought a 35.80 call, they're not going to exercise that call and buy the stock from me at 35.80 if it's trading for less than 35.80 on the open market, right? Okay, so we're going to, now you all know what the bid and ask spread is. We buy at the ask, we sell at the bid. Now, if I'm going to sell a 35.80 call, now notice, look at this column that says intrinsic. Okay, so when I took this screenshot, the stock was trading less than 35.10. Okay, when I took the screenshot. How do I know it was trading for less than 35.10? Because 35.10 has no intrinsic value. As a matter of fact, the stock was trading at 35.03.82. That's where the stock was trading. 35.03.82. So a 3,500 call option had $3.82 of intrinsic value. But we're going to trade options that have no value. Now, I want you to think about that. I'm going to take a minute and just think about this. If I sold a 35.80 call option, it's worth nothing. It has no intrinsic value. If a stock goes, now the only time a stock has no intrinsic value is if the stock goes to zero. And if a stock goes to zero, you can't sell it. You can't sell something that's worth zero because that's all it's worth. But while this option is worth zero intrinsically, remember how I started the webinar. It has zero intrinsic value, but this $3.70, that's 2 days worth of time value. Remember, we're buying or selling time when you trade options. So when you look at an options premium, option premiums are unique because they consist of two things: the intrinsic value of what it has to be worth, and then the extrinsic value, which is the dollar value of the amount of time until expiration. Does that make sense? And if it doesn't, I don't expect you to get this all in a half an hour. Come take our options course and we'll teach you everything. But options are the only asset class that has extrinsic value. Stocks don't have extrinsic value, okay? We're selling time, which will pass. Now, as long as the stock stays under the level of the option we sold, both options will expire worthless at expiration, and we get to keep the premium. So guys, on Wednesday, if I sold this 35.80 call option and collected 370, well, as you can see, the option has no intrinsic value. If by today at 4 o'clock the stock is under 35.80, this 370 will be zero. How do I know it will be zero? Because if the stock is under 35.80, it will never have intrinsic value. And this 370 represented 2 days of time. Well, at 4 o'clock Eastern today, how much time is left? Zero. So if we have zero time and zero intrinsic, what's the premium? Zero. So if I sell something 2 days ago for 370 and it expired worthless, I got to keep 370 and the stock didn't have to move. Does that make sense? Because all I'm really selling here is time. Yes, I'm selling the option, obviously. I'm selling a 35.80 call option, but I'm just selling the time value of that obligation of that option. And as long as the stock doesn't get to 35.80, which if it doesn't break 35.55, it can't get to 35.80. How cool is that? Now, if all I did was sell a 35.80 call option, that's a naked call. That's like selling a stock short with unlimited risk to the upside. Well, I don't like unlimited risk. I'm in my mid-60s now. I don't like unlimited risk. I want to know what my risk is. So if I sold a 35.80 call, I'm going to buy a 35.90 call for insurance. What is the concept of insurance, boys and girls? Insurance does what? It reduces your risk or limits your risk. Car insurance limits your risk if you crack up your car. Homeowners insurance limits your risk if, God forbid, your house burns to the ground. Okay? So if I sold a 380 call, now remember, if I sold a 35.80 call, I am now obligated to sell this stock at 35.80. What if Amazon got to 3,700 by Friday? I have to sell the stock at 35.80. Uh-oh, I don't own the stock. So I'd have to go out and buy the stock at 3,700 to fulfill my obligation to sell it at 35.80. Ouch. That's a loss of $120. Oh my God. What if the stock went to 3,800 by Friday? Oh my God. What if Amazon announced on Tuesday that their Amazon Prime Week, Amazon just sold 1,000 times more stuff than they ever thought, and the stock today was at 3,800, and I sold a 35.80 call? I have to go out and buy the stock at 3,800? Well, if somebody exercised their option, yeah, I do. I would have to go out and buy the stock at whatever price it's at so I could fulfill my obligation to sell it at 35.80. Unlimited risk to the upside. Well, wait a second. I'm going to buy myself some insurance. I'm going to buy a 35.90 call option. Now, if Amazon goes over 35.80, no matter how high it goes, the stock could go to 4,000 by today. I have the right to buy the stock at 35.90. So if I have to exercise my obligation, if I have to honor my obligation and sell the stock at 35.80, I would exercise my right and buy the stock at 35.90. Guys, if I bought a stock at 35.90 and sold it at 35.80, how much would I lose? $10. That's it. So on a $3,500 stock, I am limiting my risk to $10. And it's even going to be less than that because I'm going to get to keep a premium. I'm going to sell the 35.80 call and buy the 35.90 call for less than I sold the 35.80 for. And I'm going to be left with a premium, with a credit. I'm going to subtract that credit from the $10, which is the most I could lose on this trade. How cool is that? I mean, think about it. Most of us can't afford to trade Amazon.com. I mean, you're not trading the stock. It's a $3,500 stock. You're not buying call options on this stock. They're just too expensive. Even if you wanted to buy an in-the-money call option on Wednesday or Tuesday, I mean, you're spending $3,000, $4,000. And if you're buying a call option, you're not going to buy a call option on Tuesday expiring Friday. You're going to go out a couple of months, 90 days. It might cost you, $10,000, $10,000, $15,000 to buy an Amazon call option. Those are not inexpensive call options. Now, just like Amazon is not an inexpensive stock, maybe you can't afford to trade Amazon call options, but can you afford $10 minus a premium? So in other words, I entered a trade on Amazon where on one contract, I had less than $900 worth of risk on a $3,500 stock, no matter how wrong I was. And I'll show you why in just a second. Does that make sense? So what we're going to do, we're going to sell a 35.80 call, and we're going to buy a 35.90 call. So we're selling an option that has no intrinsic value, and we're buying an option that has no intrinsic value. We're buying and selling time, and we're going to collect a premium. And as long as the stock stays under 35.80, both of those options will expire worthless, and we will keep the premium. Does that make sense, everybody? So look what we did. As I just mentioned, now as you can see, June 22nd at 7:23 Pacific time, okay? I sold a 35.80 call for $9.62. I bought the insurance. I bought the 35.90 call for only $8.32, and we were left with $1.30 credit. So when this order got filled, and I did this in more than one account, I'm just showing you the one of the smaller accounts that I have, and I only did one contract, okay? I took in a credit of $1.30 or $130. Because for those of you who are all new, if options are sold in contracts, each contract gives you the right to buy or sell 100 shares. So $1.30 times 100 is $130. Do you always place your protection that close, or it depends? Well, remember, in this case, I went to the next strike price. Usually, except when you get this expensive, Jose and everybody else, a lot of times there's only $5 strikes. Sometimes if you're trading the SPY, there are dollar-wide strikes. So you don't have to take 10 points of risk. When you go to the SPY or the Qs or some stocks where the difference in the strike price is $1, you can do trades with even much less risk. But on Amazon, the next strike price for protection was $35.90. Now, I could have gone to $3,600 and made it a $20 spread, but I would have gotten more credit, but I would have doubled my risk. And I didn't need to do that. Okay? So we're going to buy and sell options that have no real value, no intrinsic value. What they have is time value. Remember, we don't need, on June 22nd, we don't need the stock to move, only the calendar to move. Let's say I'm buying a call. Okay, what does that mean, Larry? Let's say I'm buying a call. Well, I mean, if all you're doing was buying a call, you mean buying the 35.90 call? Well, first of all, remember, buying a 35.90 call when the stock's at 3,500 expiring in 3 days, that doesn't make any sense, because you're buying the right to buy the stock for 35.90. Okay? Well, the stock was at 3,500. Why are you spending $8.32 a share for the right to buy a stock at 35.90? Unless you think it's going to be above 3,600 by today. And 3,600 is above the supply zone. Okay, just not, okay, well, not sure what you're asking me, but okay. So guys, this is a real confirmation slip, not simulated. This was a real confirmation slip. Tuesday morning at 7:23 Pacific, 10:23 Eastern, I sold one of these, bought one of these, collected $1.30. Okay, that's cool. That $1.30 or 130 bucks would be mine at 4 o'clock Eastern today if the stock is at or below 35.80. Don't worry about 35.90. That's your insurance. Obviously, if the stock's under 35.80, it's going to be under 35.90. Okay? So, all right. We're going to buy and sell options that have no real value, no intrinsic value. This 962 represented 3.5 days of time value. This 832 represented 3.5 days of time value. And remember, the further you go out of the money, look what happens to the option premiums. The further you go out of the money, the lower the premiums get, okay? Because they're further out of the money. The less probability the stock, I mean, think about it. There's not a lot of chance the stock's going to get to 35.50. Well, there's even less chance it's going to get to 36.20. I'll show you the live option chain in a minute, okay? So I sold one option. I bought another. So by the way, the insurance that I bought, the 35.90 call, the insurance that I bought to not be naked, I didn't even have to pay for the insurance. Whoever bought this 35.80 call that I sold paid for my insurance. Because of the 962 I collected, I took $8.32 of the 962 I sold, and I used it to buy my insurance, and I was left with $1.30. I was left with that credit, with that premium. Now, when you get into that trade, okay, you can hope that it expires worthless on Friday, or you could close this trade at any point between now and Friday. If I want to buy this back for $1.20 or $1.10 or $1, now, what if the stock goes against me? What if the trade goes against me? Obviously, I've had losing trades. We've all had losing trades. I may have to buy this credit back for $1.40 or $1.50 or $2. What if I woke up on Wednesday morning and Amazon gapped up 150 points? It's happened before. I might have had to buy this spread back for $2.50. So, by the way, unless you're day trading, there's always gap risk. Unless you're day trading, always gap risk. So I might have to buy this back for, $2, $2.50. But by the way, if you shorted the stock and it gapped up 100 points, you're losing $100, not $1 or $2. So again, by doing this spread trade, while I have capped, by the way, I've also capped my profit. No matter how low this stock goes, I'm only making $1.30. Amazon could go to zero by today. All right, granted, if Amazon.com went to zero, we'd probably have bigger problems. But Amazon could go to zero, and all I'm going to make is $130. On the other hand, Amazon could go to 10,000, and all I'm going to lose is $8.70. Why $8.70? Because that's the $10. If I had to buy the stock at 35.90, to sell it at 35.80, I lose 10 bucks. But if they gave me $1.30 to play and I gave them back the 10 bucks, I'm only down 8.70. Okay? Now, let's say I'm buying a call. Strike price doesn't matter. My limit ask price is 100 bucks and is in the money. What's your thoughts if okay, I'll get to that in a second, Larry. Hold on. All right? So, does this make sense, everybody? I entered a trade, and remember, you're looking at the chart here. I sold a 35.80 call, bought a 35.90 call. Both of those options are out of the money with no extrinsic value. If the stock doesn't get beyond 35.54, both of those options expire worthless, and I get to keep my $1.30 in 2.5 more hours if I was still in this trade. Does that make sense, everybody? Okay? All right. Now, remember, when trading stocks, the stock has value. Now, the stock price is the stock price because it's the stock price. I don't mean to state the obvious. I understand whether you think the price of a stock is overvalued. There are people who think Amazon's not worth $3,500. Google's not worth $2,500. Okay, fine. GME is not worth $500. Well, guys, I hate to be rude, but what you think is irrelevant. Nobody cares what you think. And I don't mean to be rude. I don't care what you think. You shouldn't care what I think. Hell, half the time, I don't care what I think. The charts talk to me. If you think a stock is overvalued, don't buy it. But the stock price is the stock price because it's the stock price. That's the current price of the stock because that's the last price a buyer and seller agreed to exchange the shares at. But stocks don't have time value. They don't have an expiration date. Stocks only have intrinsic value. Whatever price the stock is currently trading at is the only price you can buy and sell it at. So if the stock was trading at 3,500, you can't short it at 3,600, but you can sell a $3,600 option. If the stock is trading at 3,500, you can't buy it at 3,400, but you can buy a 3,400 call option. Okay, so take a look. Now, obviously, when I took these screenshots, Amazon was trading at 34.94. Okay, and you see options that are in the money and out of the money. And by the way, look at all the different expiration dates. So what I don't have time to get into today is you need to determine which expiration date to choose. I mean, you can go out on Amazon almost 2 years to June 16th of 2023, or you could have gone, I took this screenshot yesterday. You could have bought an option yesterday expiring today, or bought options or sold options expiring in basically 2 years. You have to know whether you're buying in the money options or out of the money. Okay, the shaded strike prices are the in the money calls, and the shaded strikes over here are the in the money puts. Calls are on the left, puts are on the right. Okay, so I'm way oversimplifying this today from the 5,000-foot view, but you have to know which strike prices to choose to sell and buy, which expiration date to choose based on whether you're buying or selling. Okay, now, as I mentioned, we can close this trade anytime before expiration for a profit, or of course for a loss if the trade goes against us, or we can hope to let the options expire worthless, keeping the whole credit. Well, as you can see, I closed this trade basically 24 hours after I entered it on Wednesday, June 23rd at 7:37 Pacific. I bought the spread back for 65 cents. Basically, what did I do? I bought the 35.80 call that I had originally sold, and I sold the 35.90 call that I had originally bought. And if I entered a credit spread, I'm exiting as a debit. So they gave me $1.30. I gave them back 65 cents. I walked away with 50% of the profit in 24 hours, which also means this was not a day trade, but okay, does that make sense? So now, in this account, I only did one contract. What if you did 10 contracts in a larger account? That's $650 in a day. Now, it doesn't always happen in a day. I mean, Amazon actually started to make a move on Wednesday, so I got 50% of my profit in a day. Okay. By the way, if I stayed in the trade to today, I'd have the whole $1.30 because Amazon has actually dropped a lot. Okay. Now, every trade has risk, and selling premium certainly has risk. However, when we enter a non-directional credit spread, the risk is limited. Even on this $3,500 stock, our risk is limited to only $8.70 a share. That's it. Why $8.70? Because if I had to buy the stock at $35.90 to fulfill my obligation to sell it at $35.80, I'm going to lose $10, but they gave me $1.30. My max loss is $8.70. So will Amazon close above $35.80 when the options expire today? Who knows? But isn't it cool to be able to profit with Amazon not needing to do anything? All right. Now, let me show you something. Okay. Now, let's take a look at Amazon. Okay. Now, here we go. So here is live right now. Look what, here, let's just actually make this bigger. Look what Amazon did. So I got into the trade here on Tuesday, right here. Okay. And got out on Wednesday near the low of the day, and now look what Amazon did yesterday. Never even got to our proximal line, and Amazon is now down around 3,400. So obviously Amazon is going to close under 35.80 today. I mean, unless it goes up 150 points in the next 2.5 hours. Now, had I stayed in the, now, by the way, this is hindsight talking. Okay. I mean, could Amazon have just yesterday just blown through 35.50 and kept going? Yeah, sure. Of course it could have. But remember, it didn't even get to the proximal line of this zone. The stock has reacted nicely. I got 50% of my profit, and I am out of the trade. Okay? That is a beautiful thing. That's how Amazon. Now, by the way, this is a bearish credit spread to stay under supply. You can get into bullish credit spreads to stay over demand. You can do the same thing. You can just sell out of the money puts and buy out of the money puts instead of us selling and buying out of the money calls. Okay. All right. Let me just get to Larry's question. Let's say I'm buying a call. Strike price doesn't matter. So you're buying a call with an ask price of $100 and it's in the money. What's your thoughts if I were to limit buy? So what you're asking me, Larry, is the ask price is $100. You only want to pay 95. Is that what you're saying? That's a limit order that you just might not get filled on if I understand your question. The answer, Jose, to you is 1 day. I got in the trade on Tuesday. Expiration was on Friday, not 7 days. I got in on Tuesday this week, the 22nd. Expiration was today, the 25th. So for me, worst case scenario, I was in that trade for 3.5 days. Here we go. I got in on, there you go, Jose. I sold to open on June 22nd at 7:23 in the morning. I closed the trade on June 23rd at 7:37 in the morning. And both of that trade would have expired today at 4 o'clock. So out of the trade. If I stayed in the trade, by the way, if I stayed in the trade, I'd have kept the whole $1.30. But I took 50% in 1 day because that's just one of my rules. Okay. Well, yeah, you can't do that, Jose. Yes, that would be 300%. If you were able to do that every week, yeah, sure. You know, if you want to, you can't, for compliance reasons, you can't extrapolate that out. Yes, technically, if I did that once a week, all year, that would be phenomenal. But you can't count on that happening. So, Larry, yeah, I mean, Larry, look, you can also, I mean, you know, what you didn't ask me, Larry, is how wide is the bid-ask spread? So if your ask price to buy that option is $100, if the bid-ask spread is 99 by 100 and you're putting in 95, then you're hoping the stock comes down a little bit so the intrinsic value of the call would drop a little bit. Does that make sense, Larry? And if you do that, then you just need the stock to pull back. And if your bid-ask spread is 90 by 100, well, that's too wide a spread. I wouldn't trade options with a $10 bid-ask spread. That's way too wide for me. But if you did put 95 in the middle then, now the problem is sometimes you just don't get filled. If you're trying to, look, we all want to buy options for less than they're selling for. I get that, but at the end of the day, if the stock doesn't pull back, you don't get filled. Okay. Does that make sense, everybody? All right. So yeah, Jose, it was a great trade. Okay. And I'm usually only doing 1 or 2 trades a week. When you go to the Pinnacle Institute website, all the trades that I've placed this year and that I put, this Amazon trade was posted before I got filled on Tuesday. So any Pinnacle member could have gotten in this trade. And I've posted, a lot of trades this year, almost half of them don't get filled because it doesn't get to the proximal line, or I don't get the premium that I'm looking for to justify the trade. Okay. I did this trade for $1.30. I'm not going to do this trade for 20 cents. I'm not going to do a $10 spread for 20 cents. Okay. At some point, there's not enough reward to justify the risk. Okay. And guys, that's how you profit when nothing happens. All right. So, my apologies again. We just went the hour. We went the full hour. My apologies for all the technical stuff, the first 30 minutes. The guys, I don't know, I'm sure some of the problem was on me, but good thing I know options and I have other people who know the technology. So thanks for your patience. I really appreciate that. Thanks to Nick and Shar and Ross for their patience and helping me out. I appreciate that, guys. You guys rock. Larry, Jose, everybody else, thanks for your questions. If you guys have, interest in Pinnacle, this spread trade on Amazon was predicated on supply and demand. I didn't just pick 35.80 out of a hat. I had to understand the supply. I had to understand supply, or on bullish trades, I had to understand demand. So, for those of you watching this live or watching the recording, join us in one of our introductory workshops. Join us in one of our advanced workshops if you have some time. Here's the schedule for the next week. We'd love to see you there. All of our instructors do a great job, and obviously, I designed our options class. Our next full options class for a week will be in the first week in August. Excellent, Larry. That's great. And I designed the Pinnacle options class, and I'll be teaching the next one from Sunday to Thursday, all online right now in the first week in August. And so if anybody's interested, come check us out, and maybe I'll see you there. All right, guys, we've hit the hour mark. So Jose, Larry, everybody else who's on the call, thank you very much. And hopefully I will see you all soon. Guys, as they say on Hill Street Blues, hey, be careful out there. Whatever you're trading, please have a trade plan, follow your plan, have rules, follow your trading rules, and always remember, don't drink and trade. All right, guys, talk to everybody soon. Bye-bye.